Every year, my firm prepares thousands of K-1s for real estate investors, real estate owners, general partners, syndicators, and business owners alike. But out of those thousands of K-1s, only a small fraction do I end up preparing the personal return for, just the way of our client mix looks. And a lot of the times I have to trust that to get the full tax benefits of those K-1s, of the returns I've produced, that their CPA or their tax preparer is doing a couple of things right. And so what I wanted to talk about today were the three most common issues that I see with K-1s reported or being reported on 1040s. And we'll just do a quick primer on the flow of K-1s, how they get reported, what it means, and what's the eventual impact of them to a tax return. And so the way I explain a K-1 is a K-1 is like a W-2 for an investor or for an owner of a pass-through business, a partnership, or an S-corp. And what this K-1 does is it reports to that owner or investor how much income or loss, among other things, but basically how much income or loss has been allocated to them. How much income or loss that investor, that person, has to report on their tax return. And that has impacts to that person's or investor's return, whether it's income, whether it offsets other income or other losses, or passive income or passive losses. And so IRS gets a copy of the K-1, the investor gets a copy of the K-1, and this is kind of the way that the IRS makes sure that everything is being reported. The reason it gets tricky is because in a partnership, or especially a partnership, an S-corp a little bit as well, but allocations can change from year to year based on a couple of different factors. And so it's my job to get the allocations right. But then once I send it out, I got to trust that the CPA and their tax preparer is doing what they got to do. And so again, we're back to these are three main things and three main issues that once I've done that, once I've sent out the K-1s, that a lot of the times I see missed. And the first one is a big one. It's what's called the net investment income tax. And this is usually an error that I see when it's an active owner of a property or an active owner of a business. For example, the general partner or the syndicator of real estate deals, as long as they are an active real estate professional and they make the right election to group these rental properties activities together, they're considered active in those businesses and those properties. And so what that means is that any income that comes to them from those properties on a K-1 should not be subject to taxes on passive investments. This is this net investment income tax. So these are taxes. The Obamacare tax is what's kind of commonly referred to as, but this is 3.8% of a tax on top of these passive type income events, passive capital gains, passive income, interest, dividends. This is the income that this is kind of targeting. Well, what happens is when a preparer gets this K-1 and goes and enters it into the tax return software, if they don't go back and uncode or ungroup that, it will automatically get picked up. And so a lot of the times I see this when it was a business owner and he sold his property or he sold his business, and if he sells it on a seller note, this is going to hit him every single year. The amount of capital gains being picked up on the installment sale, if you're not going to go and undo that in the return, the owner is going to pay 3.8% of additional tax on top of ordinary income tax and regular tax or capital gains tax. They're going to pay that on top of all that when they shouldn't. Again, the net investment income tax is a passive income tax. And so when you have active income, this should not be taxed on that, even if it's a sale of an S-corp stock. Right? Those are specifically excluded. If it's S-corp ongoing income or partnership income that you're an active partner in, or a real estate professional that you've aggregated these properties and these rentals together, the income from those activities should not be subject to this net investment income tax. And so every year, this is a part of our review process, and I see it when they come across my desk for review, even when I'm talking to prospective clients, trying to work with them. A lot of times I see this snuck in there, and it can be tens of thousands of dollars or more if there's a big sale event, if there's a big event. And so net investment income tax is kind of the first place I start with. What's going on there? What should be reported? Then next one is then this what I refer to as a reverse cost segregation study, or a reverse cost seg. And what I mean by that, and this is a change that should actually be done at a partnership level, wherever the property is held. But it can also be done if the owner owns the rental property on his personal return, right? So if the owner owns a property on his personal return, what this means and what this is a way to allocate the difference between the types of gains when you sell a property. So specific to real estate, just because it's the easiest example, when you buy real estate, even if it's a rental property on your 1040, or if it's in a partnership and you get the K1, you allocate, a cost segregation means you allocate cost basis to certain classes of assets. 5-year furniture, land improvements like landscaping, buildings and land. Well, when you go to sell that 10 years later, those values have changed, right? They're not pro rata. Not everything is pro rata based on the cost seg. 10 years later, the 5-year furniture we bought and expensed in year 1 is probably gone, right? We've probably lost it all. Or if not, it hasn't appreciated in value the same way as land, or the same way as the actual structure. Landscaping 10 years later is probably done, right? And so we shouldn't be allocating income or gain to these types of assets. And so when we're preparing final year returns or sale returns on a 1040, on a partnership that's going to give a K1 to the 1040, we have to make sure that we're getting the best valuation for these types of classes of assets, because it can dramatically change the gain that these guys will pay. To the extent that it was 5-year property, 15-year property eligible for bonus depreciation, the investors and the owners will pay that back at ordinary income tax rates. Regular income tax up to 37%. To the extent we push some of that to land, they pay appreciation on land gains at 20%. If it's a building, the recapture on building is 25%, right? And then everything above that is 20%. So these really favorable rates, if we can shift any of that fair value at date of sale to building structure and land, that's what we want to do. And so again, this isn't so much what's reported on the K1. This is about what's reported on the partnership return. We need to know what's exactly being allocated to what classes, or on your personal 1040, if that's where your property is held. You want to make sure when you're filling out form 4797 that you have the right values. You have the right valuation in each type of class of asset that it asks for. And then the last bit is the last one that I see is when activities or K1s are not marked final. Now, I've been guilty of it, right? So sometimes the K1s will go out and we forgot to check the box to mark them final, but they're done, right? This is a quick fix. But a lot of times we do that, we catch that. And so when I give them to the tax preparers, I'm relying on them to make sure that that box is actually checked on their personal return as well. When you dispose of an activity, especially as an investor, it releases all of these previously suspended losses, right? And so if you're a real estate investor and you don't have enough passive income to offset these passive losses from real estate, if you don't mark that activity as final in the year it's sold, those suspended losses can stay suspended. And so you'll pay gain, you might pay gain on it or pay income tax on the gain, but you might lose the right to those losses that were previously suspended. And so what's important always is to make sure that you're checking the boxes, that they're final, that those get entered and input into the 1040, and make sure that they are marked as final so those losses get released. These are the 3 most common things I've seen. Again, it's net investment income tax, it's reverse cost seg in the years of sale, and it's marking it as final. So anytime we're selling a property, anytime activities are being sold or disposed of, there's always kind of a checklist I run through in my head, like let's make sure we've done these 3 things right. And then we entrust the tax preparers and the people we give the K1s to do the same thing, to check the boxes on the returns, to get the information filled in right. If you like the video, I would love to get feedback. Give me a like, give me a subscribe. You can find me on my newsletter. It's the same name as this YouTube channel. It's plug-newsletter.com. You can subscribe to me there. I send out weekly emails. I'll continue to do these videos as well. But really trying to grow my YouTube practice. I would love to hear from you if you liked it, or if you want some more of something else, just let me know. Thanks.